And so I'd like to invite to join me up here on the stage Izabella Kaminska, who is a former FT journalist, now the editor of The Blind Spot, focused in this area. Professor Eswar Prasad, who is a specialist from Cornell University, and John Whelan, I can just see walking here, John Whelan, who specializes in the practical end of this for Banco Santander. Do come and join me. Thanks so much. But when you sit here, Eswar there, and John, you sit here. Are you happy? So look, I should say to you that we were quite nervous about this session in one sense, which is the complexity of it is such that those people who really understand it really want a level of granular detail that may leave many of the rest of us, or certainly this one member of the audience, slightly at sea. So, Professor Prasad, one of the things we've agreed is that you will give us, I hope, a basic explanation of what we're talking about, because our worry is that we confuse our CBDCs and our cryptocurrencies and digitalization more generally. So why don't you, if you would, explain to us how you see the landscape in terms of the future of money, and then we'll dig into what the implications might be.
So one thing that's clear is that the future of money is digital, but that means a whole panoply of different options. Now, in most countries, payments are already becoming digital. So if you think about digital payments, say PIX in Brazil, or payments to the unified payments infrastructure in India, or you think about our standard Visa, MasterCard, and other payment options. Those are all digital payments where the underlying settlement asset is still in the form of central bank provided money or bank deposits which trade at par. Of course, the interesting innovations now are coming out from the new cryptocurrency related technologies, and it's worth starting with the mother of cryptocurrencies, which is Bitcoin. Now, Bitcoin is interesting because it's decentralized in a variety of fashions. It's decentralized in terms of the architecture, which means that the blockchain, the digital record of all the transactions undertaken using Bitcoins, that's maintained on multiple computers, synchronized in real time. The validation process of the consensus protocols are also decentralized, and the governance mechanism is also decentralized. So Bitcoin is a payment mechanism that is also the underlying settlement asset. Of course, the fact that it's becoming more a speculative financial asset than a payment mechanism is a different matter altogether. Then there are cryptocurrencies called stable coins, where fiat currency-backed stable coins in particular get their stable value, which is a problem why Bitcoin cannot really be an effective medium of exchange, because it's very volatile relative to the medium of account. So stable coins get their stable value precisely because they are backed up by stores of fiat currencies. So that gives them stable value, but in return, stable coins give up all of these elements of decentralization. They're issued by a particular agency or company or private firm. The validation mechanism, the rules of the game, the governance mechanism, these are all determined by the stablecoin issuer. So these are cryptocurrencies, but very different from the decentralized cryptocurrencies such as Bitcoin. Then there are more exotic cryptocurrencies that are backed up by other stable cryptocurrencies, and we've already seen with a couple of them, those are not quite as stable. Then there are central bank digital currencies, which one might think of as digital versions of the dollar bills or the euro bills that at least some of us might still have in our billfolds. That, I think, is going to be the reality of the future if we want central bank money to still have a role in retail transactions. Now, CBDCs do not use the same technology as cryptocurrencies, although in their design they could use some of the same cryptographic tools. But these are going to be issued by central banks. They're going to remain central bank liabilities, and you can essentially think of them as just being digital forms of the currency that we're all used to.
That's, for a brief moment there, I understood it all. So it felt fantastic. We should just stop now. I should say one thing. For those people who do have a kind of, as I said, a level of kind of granular question that you think really needs to be asked, I hope you'll see there's a system which is, there's a QR code. If you scan in the QR code, you can just email or sort of write in a question. It'll land miraculously on this screen, and I'll make sure that Izabella, Eswar, and John, I put it to each of you. So please don't hold back on that. And that's true through the course of the rest of the morning. Izabella, I know that we journalists take very complicated things and oversimplify them. Let's just do that for a second. In your view, when you look at this in the context of growth and fragmentation, who wins and loses in the process of digitalization of currency?
It really depends on what flavor of digitization we go down. And CBDCs are obviously the talking point at the moment. And I don't think it's determined what design we're going to have, because there are really serious issues. It's interesting hearing the previous panel. One of the issues is if we effectively recreate a full reserve system with a CBDC, which is one of the design options out there, because that could crowd out private banking, because the state would then be competing with retail payments and for funding with conventional banks. Now, if that's the pathway we go down, that could be bad for access to capital to conventional banking. So that's not, in my mind, a growth-orientated option. Now, see, I think central banks have become aware of this.
Sorry, Isabel, just go, sorry, forgive me for just asking you to go slowly. In that circumstance, CBDCs, a central bank digital currency, has a retail component to it.
Yes, so in that sort of scenario, effectively, instead of using, Santander or NatWest or whoever you bank with, you could theoretically just bank with the central bank. But that has limitations. A, because central banks, I assume, I'm not a central banker, but I assume they don't want to be retail-facing organizations. Yeah. There's a lot of, day-to-day sort of trouble dealing with customers. I'm sure anyone who deals in retail will understand that. So they would prefer for the conventional banks to do that interface with the conventional customer. But then what's in it for the banks? If they're just going to be passing on zero rate, reserves, deposits to their customers, what do they get out of it? They need some sort of incentive to be involved. So I think the central bankers are thinking about this. They've realized, so they are considering different design options at the moment. And I think the favored one is that the retail element will be quite limited to, say, very small deposits. Say 1,000 euros or 2,000 euros. Nothing is agreed at the moment, which would limit how much funding goes away from the banking sector.
But even in that circumstance, who wins?
Well, in theory, it's the consumer who would have frictionless transactions within the system. But, I'm actually puzzled by this, because as a UK resident, I've had, access to faster payments for a very long time. I can travel freely in the Eurozone with no problem doing mobile banking through my Apple Pay wallet on my phone with almost no friction. So I'm not convinced there's a consumer case out there. I think the average consumer goes, why wouldn't we just want to use Apple Pay? And then that becomes a political question, because I think the real motivation for central banks and the ECB perhaps, or whatever central bank, in turning to these CBDC-based retail payments is to challenge the control and power of organizations like Apple.
So John, can I ask you, I want to ask you about the sort of, rather than the future of money, the now of money, what's actually happening in digital currencies. But can I just start, I'm interested by your title. You're the Managing Director of Digital Assets, right?
Yes.
And one of the discussions that's gone round and round the houses around crypto has been, look, it's not a currency, it's an asset. It's an asset class. And what's your view of that?
So the digital asset space is how we practitioners would describe the different components that we actually work on. It's all inspired by the very first digital asset, programmable digital asset, which is Bitcoin, and it's grown since then really into three buckets. Digital assets comprises digital securities and other financial instruments. These are programmable forms of bonds, equities, collateral management system, mostly wholesale inside investment banks. We've got the space of digital cash, which encompasses CBDCs, central bank digital currencies, stable coins, tokenized bank deposits, FMI, financial market infrastructure tokens that might be used for settlement, again, for wholesale purposes. And then finally, we've got the world of crypto, Bitcoin, Ethereum, smart contracts, DeFi, decentralized finance, and NFTs. So the taxonomy of the space is extremely well understood by those of us who are practitioners. And so when I say digital assets, that's what I mean by the space, and then we can pick, what do you want to talk about? You want to talk about CBDCs? Okay. You want to talk about stablecoins? Fine. What about digital bonds? What about crypto? And we know exactly what we're talking about because we have a very specific and well-defined taxonomy to guide us.
And just to be clear, what's really interesting, of course, is that the digital cash is a very different bracket from the cryptocurrencies.
Correct.
And so I guess what I'm interested in is, I know we're here to talk about the future of money, but the reason I want to know about the now of money is how much of that is a real part of our financial system already?
Well, the comment earlier is that money and payments are digital. I actually would suggest that money and payments today are merely electronic. The digital money of the future will be programmable. And I'm going to give credit to a colleague of mine, Coti de Monteverde, she's not on the stage, for using this wonderful analogy is, what happens when money itself is a computer program? That's the key difference between the digital money of today and the programmable money of tomorrow. We're going to be able, we can already do this, we can embed behavior directly into the construct of the money itself. We can embed KYC, know your customer, AML, anti-money laundering rules. We can use the programmable feature of digital money to perform automated DVP, delivery versus payment, the simultaneous irrevocable exchange of title of cash and securities, without a central clearing party, without a CSD. These are things that were not possible before money and value became programmable.
And just, Anitra, I'd love to know what you think on this. So I understand the implications of that, I think, in that some of them will have competitive advantages for banks or payments providers. Some of them will have regulatory advantages in terms of oversight of movement of money within an economy. And some of them potentially will have consumer advantages. And I just wonder what you think the real driver of money as a computer code in that kind of beautiful description will be, where the benefits will land.
So if all we're going to do is use this new technology to recreate the payment systems of the past, we failed. We're not going to accomplish anything. So we have to imagine, what do the use cases of the future look like? We can already begin to see that by some of the activities that come from the world of decentralized finance, which is really about automated borrowing and lending, right? Banks perform this function today. We bring holders of capital and users of capital together in some fashion. There's a lot of automation that can be brought. For example, if you're a parent and you want to give your kids an allowance, maybe your 5-year-old kid, you give them an allowance and you embed behavior into the allowance that they can only spend it at the toy store. Your 14-year-old daughter can spend it on clothes or school books. Your 21-year-old son maybe can only spend the money, we were all 21-year-olds in college at some point, can only spend the money on sports gear, right? This is the kind of behavior that we'll be able to attach. Micropayments, the machine economy, things we can barely imagine. The real question to ask is, what is the use case of a computer? An infinite number of applications can be built on top of a programmable machine, and that's what we're beginning to think about the future of money.
I guess the thing I'm scratching at here is, and I begin to understand what the potential is there, massive potential in the way in which computer have transformed our lives. But I'm also aware of digital inequality. I'm aware of the fact that this might advantage some more than others, either institutionally or individually. And I wondered whether you could give us some sense of what that landscape might be.
So it is a challenging landscape to think about, and I think the issue is, what role does the government play relative to the private sector? So a good place to start might be to start thinking about whether central bank digital currencies really belong in the space, because a lot of this innovation is taking place in the private sector, either through institutions such as Santander participating and helping this digital space evolve, or out on the World Web where through open source code, lots of developers are creating interesting new innovations without any institutional background. So when one thinks about the government's role here, it's worth asking, what can the government or a central bank, and I'll use the two terms interchangeably for the moment, what role can it play that the private sector cannot? And what sort of market failures is it going to step in to deal with? And that goes to the heart of thinking about whether a CBDC has a useful role or not. So if you think about why central banks are going forward with CBDCs, there seems to be a range of motivations at play. In some countries, the idea is to broaden financial inclusion. Yes, Izabella can use Apple Pay and Google Pay, but it has to be linked to a bank account or a credit card. And in some countries, that's a problem. Even in the US, about 5% of households are unbanked or underbanked. So you could think about a CBDC as essentially being a low-cost digital payment system that everybody has access to. Then there is the notion that Sweden has in introducing the e-krona, which is to serve as a backstop for the private payments infrastructure, which could be subject to confidence or technological vulnerabilities. And then there is the issue of China. China, as in most things, is sui generis. Alipay and WeChat Pay do a fantastic job of blanketing the economy with digital payments, but there is a concern that those two payment giants are limiting innovation and competition. They've been controlling troves of data that the government would like access to, so the government is introducing a digital yuan. But all of this comes down to, I think, thinking about how best to ultimately benefit consumers, small businesses in particular, larger businesses, and institutions. And the programmability that we heard about, I think, really has the potential to underpin interesting new financial innovations. It could create a range of new products and services, and there is this prospect of democratizing finance. Santander might be a benevolent bank, but most banks are not going to give you a second look if you don't come in with a large sum of money in your pockets already. It's just not efficient for a bank to service a low net worth, low income consumer. But with digital technologies, the marginal cost of servicing an additional consumer falls. This is true for the traditional banking system, but also for the new banks and the online banks. So now you have more competition, more financial inclusion in principle, and programmability of money again opens up a lot of possibilities for financial institutions, but there is a darker side to it as well. Yes, you can prevent the 21-year-old version of you from misspending the money, but you could have an authoritarian government or even a benevolent government deciding that it wants you and me to use CBDC only for certain things and not for certain other types of transactions. So now we could be entering a world where, going to your point about digital equality, we actually end up not with all this promise, but potentially a world where you get even more centralization, where potentially existing institutions, perhaps including Santander, co-opt technology, and where regulatory barriers, end up, rather than fostering innovation and competition and allowing new entrants easier entry into the space, end up actually raising the barriers such that incumbents end up having an advantage. So you could end up having even more concentration and even more inequality. So there is a potentially darker side to all of this, but I'm hoping we'll get to the better place.
But, Izabella, yeah, so I don't know what to make of that, because listening to you, actually, the curious thing is, I'm sort of struck by a wave of optimism, this idea that we may see some choppy waters on the surface, but the deeper current is potentially huge around the things that you say: access to capital, developments of new financial services. And so I wonder whether, when we talk about the future of money, we're not, Izabella, just talking about mechanisms of exchange and savings. We're actually talking about a driver of growth itself. Do you think that's fair?
I think it really depends where it's deployed and how it's deployed. I mean, this idea that, that we're alluding to, that the future of money is a computer, I mean, that effectively means money we end up in a demonetized world. Like the conventional economics we have all studied in, at school go out the window, because there is no signal from a neutral monetary good out there. It becomes entirely a product and function of one's account and one's credit score, right? So there is no common unit of exchange between everybody, because everyone's dollars or euros in their wallet have different capacity for spending, right? So if I am a good citizen, might be able to spend on almost anything, flights, trains, etc. But if I'm considered a bad citizen by my system, I am repressed or given, limitations. But that has a consequence on economics, because price signals then are not what they used to be. And so we're moving, potentially the dark side is moving into this sort of what I would and have called Gosplan 2.0, Gosplan being the command economy system of the USSR, where the idea was you didn't, eventually you didn't need money, because everything would go from the person who need, from the producers to those who need, just instantaneously. Now, people have said that maybe Gosplan didn't work because it didn't have the technology. Maybe now will be different. But I think the problem with all this data-centered, computer-focused allocation is that it's always retrospective. It's always focused on what you have done in the past, not looking forward to your potential. So in terms of the potential for growth, that is really going to be a function of the government's perspective on how you treat individuals in terms of their past records and opportunities to, move away from the errors they've done when they're 21, But also, I think, very importantly, I'd just like to stress, I think there isn't enough of a conversation being had with the public about this. The public has huge anxiety about the idea of a programmable, monetary world. And I'm just always surprised that these conversations are being had in technocratic circles. You need to watch Russell Brand to really understand what the public is thinking, because that's where the conspiracy theories are coming out from, because people have anxiety about it and they don't see it as all positive.
No, I think that's right. And actually, I think even we're fortunate in this room to get access to people like you to help us understand it. But even then, there's a level of kind of confusion or misunderstanding or just lack of knowledge. And I suppose in that spirit, John, I just wondered whether you would sort of open the door for us. It's really helpful to get that distinction between digital securities, digital cash, cryptocurrencies. But if I was sitting and was part of your team on digital assets, and I was saying, okay, well, which bits of the business are really working of those three? Which ones are really promising for the bank? How does it break down?
So I sit inside the investment bank. So most of the work that my team has done is in the wholesale markets around digital securities and digital cash for wholesale purposes. But we also work very closely with the, let's say, the retail-facing parts of the Santander group, whether it's the banks in the individual geographies, PagoNext, the payments business, asset management, private wealth, etc. There's a lot of different, let's say, opportunities in a large financial institution. The cryptocurrency world from the beginning has been mostly retail first. It's a speculative asset. People like to trade these things. Stable coins are interesting, particularly in economies where you can hold a dollar-denominated stable coin and perhaps your local currency is volatile or depreciating rapidly. It's also, we're beginning to see that there are pools of funds out there looking for yields, so interesting securities with interesting cash flows can be. So the point is, any financial institution can look at different parts of their business and see opportunities to deploy these projects. My team is a couple of lawyers, we've got compliance, we have program managers, and then there's a parallel team, which is our engineering team, which builds the applications. There's almost no part of the bank, if we think about it, that cannot be impacted by this technology.
And I suppose the reason I asked that question around which parts actually grow the fastest is that they will fundamentally decide this wholesale retail distinction that Izabella touched at the beginning. My hunch is that it'll be a wholesale thing before it's a retail thing at scale. Is that wrong?
I think that the opportunity, so if you think about how money is distributed today, the central bank gives permission for the commercial banks to distribute money. We lend it into existence or we distribute it via ATMs. Okay, the same two-step model will probably exist in the CBDC, central bank digital currency world, with the first step being a wholesale step. And once you've got a wholesale step, you can do all kinds of interesting things in your liquidity management, your treasury, etc. And then on top of the wholesale CBDC, we already know how to build the retail leg. We haven't done it yet. I mean, that's still kind of a theoretical conversation. But a lot has to happen from the central banks first. There has to be clear policy. The monetary implications are not completely understood yet. The design space is wide open. There are many, many different options in how this CBDC for the world may get designed. We'll see a different approach in the European Union than in the United Kingdom, than in Brazil, for example. Roberto Campos has been very forward-thinking and talking about these things. And of course, the United States is beginning to discuss what a digital dollar will begin to look like, whether that's a CBDC, commercial bank issued, FMI issued, or non-bank stablecoin issued, or something like that.
I just want to actually wind up by asking the three of you a version of the same question. we're lucky to have a number of central bank governors coming through today. I suspect if I were a central bank governor listening to this, I would be both excited and frightened. Excited because the idea of programmability in money suggests that there is an incredible set of opportunities that await within the financial system, and that's exactly what would frighten me. I don't know what the systemic impacts of that would be. And so if you were, and forgive me, Professor Prasad, I'm going to ask you first, if you were sitting there whispering into the ear of Jay Powell or Christine Lagarde, or for that matter, the governor of the Bank of Spain or Brazil, how would you advise to progress on CBDCs and the whole range of digital currencies?
I've not just whispered, but talked to a few. This is a very fraught time for central banks and regulators, because this whole space of cryptocurrencies and digital assets is creating some new forms of existing financial risks. For instance, stable coins look like unregulated money market mutual funds, which, as we know, caused some problems during the financial crisis. There are also potentially new types of risks coming up, because we have new financial technologies, new financial ecosystems developing. In principle, some of these risks can be managed. As John pointed out, one could even think about embedding not just know your customer requirements, but even regulatory modules as part of some of these decentralized finance products even, so that you have even these products potentially being regulated. Now, we don't quite know the systemic risk implications, even if you do that at a product by product level. But I have a more fundamental concern related to the possibility of CBDCs, especially programmable CBDCs and so on. You could think about, for instance, money that has expiry dates. If you want to have a coronavirus stimulus that is effective, you want people to go out and spend the money, perhaps on anything, preferably on durable goods. The problem there is that once you have the central bank now seen as potentially having this ability to deploy fiscal policy in this more targeted way, perhaps to use central bank money to make sure that it's not used for any illegal purposes, so it becomes an agent of the government, or if the central bank actually starts effectively taking deposits in the way that Izabella earlier alluded to. Now the central bank takes on even larger a mandate than it already had, and that, I think, has very serious risks to the integrity of central bank money, if you have different types of central bank money floating around, and to the credibility and autonomy of central banks, because they start being seen as agents of the government. So I think there is a good possibility inherent in CBDCs that central banks can use that as a tool to achieve objectives like greater financial inclusion, payment system stability, but there is a big risk.
And Izabella, how much do you then worry about, if you like, regulatory reluctance? That people think about exactly what Ishwar's saying and say, actually, central banks, we want to stay away from this, and the whole thing grows outside of the purview of central banks?
So I think, things are happening on two tracks. What's happening in the private sector is going to keep happening, which is one of the reasons you've seen this huge sort of reaction from the central banks and all the proof of concepts, research, et cetera, we've seen with CBDCs. It was a response in many ways to stable coins, to Libra, Facebook's Libra project, et cetera. I think they were, on the back. I mean, I don't want to speak for central bankers, but it seems to me they were on the back foot until these things came to the fore, and they couldn't ignore them anymore, right? But in terms of what central bankers will do in terms of regulatory response, I mean, it's hard to say. Again, it's so specific to the problem. I think the bigger issue is the paradoxes. So if I was to speak to the central bankers, I would focus on what problem are you actually trying to solve, and are the problems you think you are solving possibly open to paradoxes. Like, one of the key ones is the inclusion, because I can see the central banks want to create a public digital good, and that is a worthy goal. I really do think it's worthy. But indirectly, if they're also going to enforce KYC and AML, they have to have the power to deplatform, because how do you penalize those who do misuse the system. And I think in Nigeria with the INERA, we're seeing that actually the financial inclusion isn't there as much as people thought it would be. A, because adoption is quite low. People don't have a trust in the INERA system. So there are other issues, and trust is one of the biggest ones. So if you're going to have a functional CBDC, it has to be issued by a trustworthy government. And unless the central bank and the government work in harmony on that front, it's not going to succeed, in my personal opinion.
John, we heard at the beginning of the day Anna Butin saying it would be good to have a plan. And I take what Izabella says around central banks being on the back foot. I think you could reasonably say that they're dancing now, and to different rhythms and at different times. You've got some banks, you look at China, it seems to be moving at a different tempo to, for example, to the European Central Bank, to the Bank of England, to the Fed. Do you get a sense that there is something coordinated that's happening here? Does it need to be coordinated, or is there a benefit in these different speeds and the competition that arises from it?
I don't think it's formally coordinated. I think the central banks talk to each other. In many respects, this move towards central bank issued digital money is geopolitical in nature. I think the Chinese government sees it as an opportunity maybe to distribute the yuan across the world, in Asia and other developing economies. And of course, the United States and the European Union and other large central banks will have to respond. I'm going to say something controversial. I do not believe that central banks themselves need to issue digital forms of their own currency. I think a prudent approach would be wait and see, provide a suitable licensing framework, a rule book for private industry, whether it's banks, non-bank issuers, e-money issuers, stablecoin issuers, and then an appropriate account structure at the central bank. It could be some form of technical reserve account to operate so that it ensures settlement. And listening to comments from particularly the Federal Reserve, Governor Walker recently, a couple of weeks ago, implied heavily that that's the approach that the Federal Reserve is going to take, because the digital dollar already exists. Tether, USDC are digital forms of the United States dollar that are issued by non-bank issuers. There are also many, I think, discussions underway by the commercial banking sector, whether it's in Europe here or in the United States, about how do we take existing bank deposits, make them programmable, and put them on your phone, just like your today's bank deposit is. That's probably a good, prudent first step. But having said that, we do see some of the central banks, particularly the ECB, for example, being quite active in promoting the digital euro. There are separate drivers for that. I think it's more about politics than the technical aspects of money.
So I want to finish up by asking all three of you one thing, which is a very practical thing, and it concerns all of us in the room. I remember being taken by my dad to an ATM for the first time, and he says, look at this, the money just comes out of the wall. And it just seemed amazing to me. And for probably most of my adult life, that was in many ways still the most amazing innovation in my personal finance. Money would just come out of the wall. And now I look at my financial life in the last 10 years and the speed at which things have fundamentally changed, the relinquishing of cash, the complete reliance first on card, now on phone and platform. And so I see completely the move, as you've all described it, from the physical to the electronic, now to the platform. But I don't have any meaningful digital currency in my life. And I just wondered, between I think, Izabella, maybe I do and I just don't know it, but I just wondered whether each of you would say, in a practical sense, for all of us in the room, when you think, assuming we're not all Bitcoin investors, when you think we will see digital currency playing a meaningful and regular part of our financial lives? John, why don't you go first?
That's a good question. I mean, people like myself are first adopter. I was using 10 years later, right? I'm already using digital currency in my life daily. And
what do you do with it?
Say that again?
What are you doing with it?
I use it for payments. I explore DeFi, decentralized finance, NFTs. I'm a fan of digital art. The currency of record for non-fungible tokens, digital art, is actually Ether, which is a cryptocurrency. It's interesting, right? So this is already being used. Big brands. Nike has an NFT business that they purchased about a year ago. This is happening for real. It may not be happening with our generation in this room, but talk to your kids, right? Big brands are getting into digital art. Loyalty points are going to be digital and programmable. We're beginning to see it already. Now, does that mean that you're using digital pounds, digital euros, digital dollars? Maybe not, but you're beginning to touch the space. And I think, you know, it's going to be driven probably by mainstream marketing and brands first, and we'll see more and more of it. Many of the football teams, NBA, Top Shot, right? There's a lot of this going on. Talk to your kids.
So, okay, that's probably the answer. As is so often the case, I'm just going to get leapfrogged. Eswar.
So to echo Izabella and deviate a little bit from John, I think trust is really going to be important in terms of payment mechanisms. So I think we'll come up with more effective ways of using trusted central bank money in the form of, say, stable coins or other digital assets where the stable value comes from this underlying source of trust. But certainly there is a new world out there, decentralized finance, where I think it's stable coins that are not necessarily backed up by fiat currencies, but are backed up by the deep pockets of corporations like an Amazon that could start gaining traction and could perhaps take precedence over the monies of central banks that are not trusted, that are not very credible. So I think what we are in for is a very interesting era of currency competition and perhaps a bifurcation of the roles of money.
And the timescale, that kind of thing, that sort of Amazon usage, 2 years, 3 years, 5 years, what do you think?
I think within the next 5 to 10 years, we are all going to be using electronic forms of payment, and I think John was more precise in his use of that term than I was. But I think these alternative forms of finance are going to gain a fair bit of traction over the next 5 to 10 years. Again, they're likely to remain limited relative to fiat currencies, but they will gain some traction.
Isabella?
So I take issue with the idea that we don't already have digital currency, because I use digital currency every day. It's just a question of whose liability, I'm using, So I use currently private banks' liabilities as a digital currency. So do you. We all do, right? So what we're talking about is just a shift of whose liability, whether it will be a central bank or whether it will be some, public blockchain, etc. And then I would just say it's really, I also agree that this is going to be a battle of trust. So different trust networks versus others. And all the consumers out there have different preferences. Some people value privacy more than, say, practicality. Some people value censorship resistance over different aspects. So everything is going to be a function of the context that you are in. So if you live in a low-trust society, you will value perhaps privacy and censorship resistance more so than the practicality provided by a central bank digital currency. If you live in a high-trust system, then you might not have any issues with using the digital cash issued by your bank. But in terms of a positive, I also want to finish on a positive turn. Where things get interesting with NFTs and things like that is this idea of completely restructuring how, say, bond issuance happens. And one idea that I was very taken with, for example, is an idea floated by Neil Collins that the UK could fund itself by issuing perpetual Elizabeth bonds. But imagine if they were structured as NFTs. That would be quite useful.
Well, there is a thought. We're going to, as we wind up here, this is one of those moments where the handover is not just personal, but it's intellectual. We're joined in a moment by Nadia Calvino, who is the vice president and responsible for exactly this intersection, the economy and digital transformation. And it's interesting that we end the conversation with this fundamental question of trust. I guess we started, Eswar, with a question of understanding. Do we have the knowledge we need? The more knowledge you get, the more you begin to understand these are going to be systems of trust, and as currencies always have been. So I'd just like to say, on behalf of all of us in the room, and very certainly personally, the chance to have a conversation like this and to try and get a real understanding of not just what's going to happen, but what's happening right now has been a great pleasure. And so I hope you'll join me in thanking John Whelan, Eswar Prasad, and Izabella Kaminska. Thank you very much indeed.
Thank you.
Thank you.